Welcome to this video on SAFE Agreements, which stands for Simple Agreement for Future Equity. This is part of our Startup Finance series, where we break down essential financial instruments that every entrepreneur should understand. SAFE agreements have become one of the most popular ways for early-stage startups to raise capital from investors. Let's dive in and explore what makes them so valuable. A SAFE, or Simple Agreement for Future Equity, is an investment contract that gives investors the right to receive equity shares in a company during a future financing round. Unlike traditional loans, SAFEs have three distinctive characteristics. First, there are no interest payments required. Second, there is no maturity date, meaning there's no deadline for repayment. And third, the investment automatically converts to equity when certain conditions are met. This makes SAFEs fundamentally different from debt instruments. There are several compelling reasons why startups and investors choose SAFE agreements. They are simple and fast, with much less legal complexity compared to convertible notes, which means deals can close quickly. They are cost-effective because they involve lower legal fees and faster negotiation processes. SAFEs are founder-friendly since they don't create debt on the company's balance sheet and don't accrue interest over time. Finally, they are flexible, automatically converting to equity during the next financing round without requiring additional negotiations. Understanding the key terms of a SAFE is crucial for both founders and investors. The valuation cap sets the maximum company valuation at which the SAFE will convert to equity, protecting investors if the company's value grows significantly. The discount rate gives investors a percentage discount on the price per share compared to new investors in the next round, rewarding them for their early support. Trigger events are the specific circumstances that cause the SAFE to convert into equity shares, such as a new financing round or an acquisition. There are four main types of SAFE agreements, each offering different terms. Type 1 has a valuation cap only, which sets the maximum conversion valuation. Type 2 has a discount only, providing a percentage discount on the next round price. Type 3 combines both a cap and a discount, making it the most favorable option for investors because they get both protections. Type 4 is called Most Favored Nation, or MFN, which allows early investors to adopt the terms of future SAFEs if those terms are more favorable. Let's look at a practical example of how a valuation cap works. Imagine an investor puts in $100,000 with a valuation cap of $5 million. Later, when the company raises its Series A round at a $10 million valuation, the SAFE investor doesn't convert at the Series A valuation. Instead, they convert at the $5 million cap. This means they receive twice as much equity compared to Series A investors who paid the higher valuation. The valuation cap rewards early investors for taking on greater risk. It's important to understand how SAFEs differ from convertible notes, which were previously the standard for early-stage investing. Convertible notes require interest payments, while SAFEs do not. Convertible notes have a maturity date by which they must either convert or be repaid, whereas SAFEs have no maturity date. Legally, convertible notes are structured as debt, which appears on the balance sheet, while SAFEs are not considered debt. Finally, SAFEs are significantly simpler and involve less complexity in their terms and documentation. There are three main events that trigger a SAFE to convert into equity. The first and most common is an equity financing round, where the company raises a new round of preferred stock above a certain minimum threshold amount. The second trigger is a liquidity event, which occurs when the company is acquired by another company or goes public through an initial public offering. The third trigger is a dissolution event, where the company winds down its operations and liquidates its assets. In this case, SAFE holders typically receive their share of remaining assets after creditors are paid. Like any financial instrument, SAFEs have both advantages and disadvantages. On the positive side, they are quick and inexpensive to execute, with minimal legal documentation required. They don't require interest payments or repayment of principal, and they're flexible and founder-friendly in their structure. The documentation is also standardized, thanks to templates from organizations like Y Combinator. However, there are downsides. Safes dilute founder ownership when they convert, sometimes significantly if multiple safes are issued. Investors face valuation uncertainty since the final equity percentage isn't known upfront. Safes can complicate the capitalization table with multiple conversion terms, and they offer limited investor protections compared to preferred stock. Let's recap the most important points about safe agreements. First, safes are simpler and faster than convertible notes, making them ideal for early-stage funding. Second, the valuation cap and discount rate are the key mechanisms that protect investor upside, rewarding them for early risk. Third, safes have no interest payments, no maturity date, and are not classified as debt, which keeps the company's balance sheet clean. Finally, safes are best suited for pre-seed and seed-stage startups that need to raise capital quickly without the complexity of a full-priced equity round. Understanding these fundamentals will help both founders and investors make informed decisions about using safe agreements.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.